Hi all. This is Parthiban Anandan. Hope everyone is doing good. In the last series of videos we saw the 26 rules of money. Now let's see the next set of rules in this video. Rule number 27. Leverage turns good deals into great deals. If someone told me back when I was just 19 years old that you could use debt to make a fortune, I would say you are an idiot. I would never, ever go into debt because I grew up having such a negative opinion about that. Leave alone the interest you get charged on top of it. But it turns out that that isn't as bad as I imagined. It's actually good. In some cases. Take this case. For example, let's say you want to buy a house and you have $1 million in cash. If you have a really strong credit score, you can get a 3% mortgage rate. Of course, you can spend that $1 million to buy a house, or you can get a mortgage and invest that $1 million elsewhere, like the stock market, for example, and get, let's say, 7% annually. In the second scenario where you are using that, you aren't just getting the house, but letting that money grow by additional 4%. This is, of course, a super simple example because we didn't take into account the down payments and the market fluctuations. But that's the idea. In general, every successful real estate investor has used debt in some form to be where they are today. Often they use their first mortgage as a collateral to get the second one and rent it out and so on. Instead of saving to buy each property, you can use that to save yourself decades worth of time. Rule number 28. Tax loopholes are made to be used. No one likes paying taxes, but the tax code isn't just black and white, except the income tax, where it gets higher as you make more money after 37%. But it's filled with loopholes where you could be making millions of dollars and pay absolutely no taxes, because on paper you could be showing loss. Let's say you have a $300,000 mortgage with a mortgage rate of 3%. You can deduct your mortgage interest from your rental income, which means if you make $30,000 from that house, you could be deducting $9,000 from age. Now, instead of paying taxes on $30,000 out of a sudden, you only have to pay on $21,000. That's why it's even better to get a mortgage even if you can afford to buy the property. There is also something called depreciation. Almost everything we buy depreciates over time, and tax codes usually allow you to use depreciation as an expense, although you lost nothing and further lower your income on paper and minimize taxes. Companies use this strategy all the time. If you just pick the financial statements of any company, you will realize that they always have depreciation in their income statements. If you end up buying another one in return, we can talk forever about the loopholes in tax code. But that's the idea in general. Let's see the next set of rules of money tomorrow. Stay tuned. Thank you. Signing off. Parthiban Anandan. For details contact Parthiban Anandan, Financial Service Professional, Golden Capital Services, LLC, 717-836-0414, info.goldencapitalservice@gmail.com.